tell us a little bit about what you're watching for 2022. What are some of the risks, but also perhaps some of the opportunities that you see out there?
Okay, let me start by saying that, what we're telling our clients is we are modestly positive on the medium-term outlook for the markets. Markets have done exceptionally well in the last couple of years, or rather more precisely in the last 21 months or so. And so valuations are not as attractive, but neither are they too expensive at this juncture. I'm talking about stock market valuations. And so we see more upside. We think the easy money has been made, but there's still money to be made. As far as risks are concerned, two elements of risk. Number one is the COVID-19 figures. Omicron remains a risk. We've seen a surge in infection numbers in the last few days. That clearly calls for some degree of caution. And of course, the inflation numbers that will be announced, as you said, in the coming week. Several countries around the world are announcing inflation numbers, including Europe. And so markets will be fixated on inflation as well, because that is a bearing on monetary policy. So the risk factors would be inflation and COVID-19. But then again, there is a silver lining, because there's hope that, with greater vaccination, COVID will ease, supply disruptions will ease, inflation numbers will come off, central banks may not be as aggressive as we think they will be. And that could be a positive for risk assets, including equities. So we are generally, in a nutshell, positive in equity markets.
Vasu, you say in your notes that you upgraded your rating on India to neutral, and you've maintained your stance on MSCI China on neutral as well. Given the COVID risks that you talk about, of course, we saw how much havoc COVID-19 wreaked on the Indian market as well. What will this do to those two economies, especially when China is also holding, as Paul mentioned earlier, that COVID zero strategy?
You're right. I mean, yes, these markets have done, India has done exceptionally well in 2021. So valuations are not as attractive, but earnings growth in India is very, very strong. I think overall, India has done a relatively good job in terms of COVID-19 management. In the case of China, putting aside COVID, I think the stock markets have been hammered very badly. Chinese stock markets have pulled back very, very sharply. One of the worst performing stock markets in 2021. And so value is starting to emerge, but we are neutral. We're not positive on China yet, because we're still keeping a very close eye on the macro picture in China. There are signs that the government is easing up, but we're waiting for more signs on economic data and policy before we turn a bit more positive on China, because the Chinese stock market is very volatile and not something that's suitable for everyone. I think we see better outlook for China probably in the second half of the year, in the run-up to the NPC at the end of 2022.
So you're neutral on India and China, but you said earlier there is still money to be made. So where do you go to make that money?
Well, we are more positive on equities compared to bonds, but within the bond segment, we are relatively positive on our high-yield bonds, because the real interest rates are deeply negative, and we think the search for yield will continue. In the equity space, we are positive on U.S. equities. I know U.S. equities have done very well, but we remain positive on the U.S. equities. We still think there's more upside for U.S. equity markets. And in terms of other regions, Asia, Japan, and Europe, we're neutral. We're not negative, but we're keeping a very close watch on some of these regions to see whether they need to be upgraded in due course. And so we think there are opportunities in the equity space as well as the bond space, but in the bond space a bit more selective given rising interest rates.
It was a pretty rough year last year for the Hang Seng. What's your outlook for China 8 shares?
Well, I think, as you said, pretty rough year, and valuations are now starting to look a bit more attractive for Chinese equities. I think going forward, the key thing is really the macro headwinds. We're seeing some signs of easing. The government is indicating some degree of support. The PBOC has cut the RRR ratio twice. The rhetoric coming out of China is that they provide more support. But on the property front, you've got a lot of maturing bonds coming up in China. Don't think China is going to bail out many of these companies. So, that's a headwind for the Chinese equity markets. We want to see a bit more policy action from China. I think the tightening regulatory crackdown will continue, at least in the first half. But as we approach the second half of the year, I think things will start looking a bit better. And, that's where we see better prospects for China.
Will loosening policy help weaken the currency? Because we have seen authorities sort of run out of patience when it comes to the strength and resilience that we've seen with the Chinese yuan.
Well, possibly, to some extent, it may help to, ease some of the upward pressure on the currency. But more than that, the currency aside, I think what markets are looking out for is signs that the regulators are easing up on tighter regulation. We've had tighter regulation in the property sector, tighter regulation in the internet sector, for example, and internet stocks have been badly beaten down in China. So when there are signs of more easing of these regulations and more policy support, fiscal policy and monetary policy as well, I think then China may provide pretty good returns going forward. But as I said, it's a very volatile asset class, and one has to tread carefully and best to tread gradually because things are still playing out.